In today's video, I want to give you a breakdown of the new economic analysis that Fannie Mae just released. But long story short, start saving your money because they're predicting a mild recession in 2023, just like the mild inflation of 2022. Jokes aside, earlier this year, they made a prediction about what would happen to inflation, and they told us that they think inflation would average something like 7%. So let's see how their prediction held up so far, because the CPI, the Consumer Price Index, which is the thing that measures inflation, clocked in January at 7.5%. For February, it was 7.9%, and for March, we hit 8.5%, for an average of 8% in the first quarter. And that makes a huge difference from their initial prediction of 7%. So in today's video, I want to give you a breakdown of what they're saying will happen to interest rates and real estate and stocks and crypto and NFTs and how this will affect us, because maybe they're right about the coming recession, but maybe based on their track record, not about how bad things could potentially get, and that's what I want to explain. So let's get right into it. Hi, my name is Andrei Jikh. Hope you're doing well. Come for the finance and stay, because I'm gonna sound like this guy trying to explain this video. So if at any point it sounds confusing, it's only because it is, and I was confused making it. I'll try my best to keep it simple, but let me set the stage for what's potentially about to happen by looking at the past. Every 10 years, the stock market does something incredible. People make money for 10 years in the stock market, and for the next 10 years they lose money. And the next 10 years they make money, and the next 10 years they lose money. And this cycle keeps repeating itself over and over again. For example, between 1989, which was the year I was born, to 1999, the stock market returned 16.7%. It was an incredible time to be an investor. I was like 10 years old, so I wasn't investing, but when I was ready, between 2000 and 2011, the stock market didn't make money. It lost 0.13%, which is not a ton of money to lose, but think about it like this. Imagine you invest $1,000 and then you check on it 10 years later to find out that now your $1,000 is worth $998.70. You would be so discouraged to realize that 10 years worth of progress amounted to nothing. What is this stock market thing they talk about, right? So a lot of people quit. But if you had held on between 2011 to 2021, you would have made 13.2%. So basically the stock market giveth and the stock market taketh away. And so the thesis is, in the next 10 years, between 2022 and 2032, the stock market could either stay flat or potentially end up losing money. And that's where this story begins, and here's exactly how that might potentially happen. Let's first address this man. It all goes back to him, Papa Powell. This man's job from the beginning is to give us a soft landing, meaning a soft transition between cooling everything down without increasing the rate of unemployment. In other words, let's slow everything down without getting people fired. And right now, inflation is telling the Federal Reserve that it's becoming really expensive to live life fast, faster than we expected. Therefore, the Federal Reserve's response with tighter monetary policy by way of increasing interest rates is going to threaten our soft landing without causing a recession. Because historically speaking, soft landings have been extremely rare. From 1955 to 2019, we have had 10 hard landings, meaning every time we've tried to slow down inflation by increasing rates, we hit a recession 10 times. And in that same time period, we've only had 3 soft landings where we avoided it. I feel like Dr. Strange saying all that. How many possible soft landings without a recession did you see? 3. Here's why this happens. This is gonna get pretty heavy, doc, so if you don't understand much of this stuff, trust me, it took forever for me to understand too. I will tie everything together and make sense of it, but the technical term is the end of the monetary expansion cycle. And here's how you know we're coming to the end of it right about now. Let's face it, things aren't looking that good. Roughly 81% of the country is worried about a recession, and a head economist at Harvard believes the recession is already here. The leading recession indicator, the Treasury's yield curve, has already flipped. Personally, the way that I'm preparing is by investing into alternatives, and they've done pretty well for me. And while I realize that we can't time travel and go back to buy Bitcoin at $8,000, I think this next opportunity is just as exciting. I've told you about them before, and thousands of you answered the call, and I'm referring to the alternative investing platform called Masterworks. Masterworks lets you diversify your portfolio in fine art for just a fraction of what billionaires pay to purchase. And after I told you about them, wow, you guys went above and beyond because Masterworks sent me the stats, and we have collectively invested over $1 million on their platform in paintings by Banksy, Basquiat and Picasso. So as I've explained before, Masterworks unlocks access to an ultra-exclusive asset class that 73% of millionaires and billionaires know is invaluable to have in their portfolios because they know that contemporary art prices have outpaced the S&P 500 total return in the last 25 years by a whopping 164%. Not only that, but since launching in 2019, Masterworks has sold 3 paintings with each returning over 30% net internal rate of return to their investors. Now legally, I have to add that past performance is not a guarantee of future results, but 30+% is pretty mind-blowing, and that's why they've already been valued at over $1 billion. So if you want to get in early and skip the waitlist, click the special link in the description below the video. Now let's get back to it. Here are the 3 key takeaways that you can use to help you figure out that we are coming to the end of this 10-year cycle. And the first is the unemployment rate is below the full employment rate. In other words, the full employment rate, as defined by the BLS, is an economy where the unemployment rate is equal to the non-accelerating inflation rate of unemployment, or NAIRU. I realize I sound insane, and that's because before making this video, I've never even heard of the acronym NAIRU as it applies to economics. It's kind of like the physics of dark matter. Physicists think that 85% of the universe is made up of this stuff called dark matter, right? But they haven't conclusively proven it. But there are strong suggestions that this thing exists. And it's the same thing with NAIRU, but in economics. And the most interesting thing about NAIRU, which by the way is mentioned in this research paper that I'm sharing with you, I'm not making this stuff up, is that it can't be measured. And there's no index I can show you that says, see, it exists and here's where it's at. But it does exist, and the Congressional Budget Office and various branches of the government tries to measure it and calculate it when thinking about the economy. And here's exactly how it kind of works. When the central bank sees a spike to the wage growth, it responds by increasing rates to slow everything down. But when it does that, it also comes at the cost of increasing the rate of unemployment. And if the rate of unemployment goes above this invisible NAIRU line, that's when an unexpected neighbor shows up. And that neighbor's name is recession. I swear I'm not crazy. Take a look at this chart. This right here is the wage line, and this right here is the unemployment line. Our goal is to bring down this wage line, which is very high, without affecting this unemployment line, which we don't want going up. But like so many times in the past, when wages have gone up and we tried to cool them down, it came at the cost of unemployment going up. And when the unemployment line breaks above this NAIRU line, it's usually right around the time of a recession, which are these gray bits right here, which marks the end of the monetary expansion cycle. The second way to know and measure that we're coming to the end of this monetary expansion cycle is the rate of inflation. And I know I don't need to preach it to anyone that inflation is getting worse and worse every month the CPI data comes out. We are setting multi-decade record highs. Every month is higher than the month before, and that's how we know we're coming to the end, because the third way to know is the Federal Reserve's response to all of this, because the age-old saying is, don't fight the Fed, and their job right now is to slow us down, and that's how we know we're coming to the end of this expansion cycle. Just take a look at this chart, which compares the federal fund rate, also known as interest rates, against wage growth. So this line right here is wage growth, and this line is the interest rate. Now we're supposed to be in lockstep. As wages go up, the Fed catches up, increases the rates, and slows us down. But look how much wages have gone up recently and how the Fed is asleep at the wheel. They need to play catch up, and they need to do it fast. Those are just some of the things we can use to tell that we're coming to the end of the monetary expansion cycle. Now, inflation is becoming such a big problem that some members of the Federal Reserve want to increase their inflation target from 2% up to 3%, which is pretty wild. Now, this is where the research paper takes a slightly darker turn and says that's why they predict a recession specifically in 2023. And the question I had is, how do they know? Why specifically 2023 and why not this year? And this is how you can tell. The biggest reason is because economists estimate that it takes anywhere between 12 to 24 months for monetary policy to be felt in the real economy. And this makes perfect sense because in 2020, what did we do? We dropped the rates to 0 to stimulate the economy, but we didn't feel the full effects of inflation until this year in 2022. We're seeing it in full effect now. And now that we've started to increase our interest rates, it's going to take us another 12 to 24 months to finally feel their effect. And that's why it would take us until 2023 at the earliest to feel the full effects of that deflation. That makes perfect sense. When it comes to real estate right now, interest rates have now hit 5%, the highest they've been since around 2009. And home affordability is now at the worst level, second only to the 2005-2007 era. They're also predicting that in the next 6 months, even though consumer demand is still strong for housing, that it will substantially fall, which makes sense as interest rates go up. Fannie Mae estimates that by 2023, home values, when adjusted for inflation, will grow by 0%, with some parts of the US to fall or be negative. And that usually happens at or around the time of a recession. Now, when it comes to stocks, speculative stocks like in the growth sector, like tech stocks, will probably fall pretty substantially. And we can already see cracks of that with stocks like Netflix, which is down 36% or over 43% in a week, which is insane. And that could set the tone for the rest of the tech and the stock market. That's why most of my investments in my stock portfolio are all dividend stocks, or at least most of them, because when it comes to times of hardship, people prefer to take an income over taking risks. And that's why they typically tend to do a little bit better. Even more speculative assets like Bitcoin, Ethereum, and especially NFTs are going to lose a ton more value as people sell off those investments and fly to safety. Also, consumer sentiment is not looking too good, with most people thinking there's going to be a recession, and the spread on the 2- and 10-year treasury yields have flipped. And that's the inverted yield curve, which signals that after it happens, there's going to be a recession 6 to 18 months from that point, and it happened just recently. Now, all of these things that have been mentioned in this research paper by themselves do not predict a recession, but it's the amalgamation of all these little things working together that suggests a probable recession sometime in 2023. But the bigger question is, how bad are things gonna get, and what can you do about it? If you're young, it doesn't matter, because you have the luxury of time to wait it out and wait for the next 10-year period where you are making money. So the best course of action has historically been to do nothing and continue investing right on through. But if you're older, you may not have another decade to wait around before the stock market recovers, in which case that is something different. And if it was my parents and I was talking to them, I would ask them to consider looking into I-bonds. I-bonds are some of the safest investments you can make because they're bonds from the government. And as of right now, the I-bond is yielding 7.1% per year, which is really incredible. And every 6 months, their interest rate readjusts and it's pegged to the CPI, the thing that measures inflation. And get this, later this year, in May, their interest rate is going to readjust to 9.6%, which is an amazing return. That's how much you would expect in a good year from the stock market. So I-bonds might be good for someone who doesn't want to keep their money in cash because they understand inflation is going to eat away at their purchasing dollars, but they also don't have 10 years on their side to risk the volatility in the stock market. The only downside, though, is that I-bonds limit your contribution to $10,000 per year. There is a way to get around some of the limit, but it's a little complicated and not the scope of this video, but it's a neat little trick to maybe look into. By the way, everything we've talked about in this video is not an exact science. It's more like an interpretive art, and you might see something different, which is also why economists disagree with each other all the time, despite looking at the same data. Because some of them might look at this data and say, this is how we know a recession is coming. And the other half might say, you're taking a bunch of things that happened to correlate and you're trying to extrapolate it and predict the future. But it's already happened, it's in the past, and it doesn't predict what's going to happen. And neither point of view is right or wrong, it's just a different perspective. My point of view is that the more I understand about the complexity that is the economy, the more my investing decision becomes informed. Rather than be driven by fear or some other random emotion which doesn't help my investing, this can hopefully make me understand a little bit better, and I think it's better to stay informed. As always, love you. Thank you so much for watching this video. I'll see you on Monday and Friday, sometimes a Wednesday. Free stocks, all that stuff is linked down below. In the meantime, I'll see you soon. Bye-bye.